In the last 2 years, 4 American companies have committed to spending more money than the entire GDP of Sweden on infrastructure most people have never seen, powering technology most people don't fully understand, to generate returns nobody can yet reliably calculate. That's not a warning. That's the pitch. Microsoft, Google, Amazon, and Meta are collectively on track to pour roughly $725 billion into AI infrastructure in 2026 alone, up 77% from last year's already record-breaking $410 billion. And Goldman Sachs now sees those same 4 companies spending a combined $5.3 trillion through the end of the decade. $1 trillion. That's just the beginning. So here's the question that should be keeping every serious investor awake right now. What if the bet doesn't pay off? To understand the scale of what's happening, you have to go back to 2022. That November, OpenAI released ChatGPT. Within 2 months, it became the fastest-growing consumer application in human history. Silicon Valley panicked. Wall Street got excited. And somewhere inside the boardrooms of the world's largest technology companies, a single terrifying thought surfaced simultaneously. What if we miss it? That fear, not a spreadsheet, not a 10-year plan, is what launched the largest capital expenditure cycle in the history of computing. In 2024, the 4 biggest cloud providers spent just over $200 billion on infrastructure combined. Within 2 years, that number is approaching $700 billion. To put that in perspective, the entire annual budget of the U.S. Department of Defense is roughly $850 billion. These 4 companies are spending nearly that not on planes and missiles, but on data centers, chips, and power lines. And the acceleration shows no sign of stopping. Analysts are already projecting the number breaks $1 trillion by 2027. At the center of all of it sits one company that almost nobody saw coming. In 2019, Nvidia was a well-regarded semiconductor firm, best known for making graphics cards for video games. Its market capitalization was around $100 billion. By February 2026, it had posted full-year revenue of $193.7 billion, a 65-fold increase from 6 years earlier, and became the most valuable company on Earth. Jensen Huang, Nvidia's founder and CEO, has a standard line he gives to analysts. Demand for AI compute keeps accelerating and compounding. It sounds like boilerplate, but the numbers back him up. In the first quarter of 2027's fiscal year, Nvidia reported $81.6 billion in revenue in a single quarter. Its data center segment alone, the chips powering AI, hit $75.2 billion. That's in 3 months. To buy an Nvidia H100 GPU in late 2024, companies were waiting 6 to 12 months. Blackwell sales are off the charts, Wang told investors in late 2025. Cloud GPUs are sold out. His customers weren't quibbling over price, they were begging for allocation. This is what a gold rush looks like when the gold is made of silicon. But here's where things get interesting. Every gold rush in history has produced 2 kinds of winners: the people who struck gold and the people who sold the shovels. Levi Strauss made more money off the California gold rush than almost any miner. The question now is whether we're watching the shovel seller win again, and whether the miners are digging in the right place. Because on one side of this trade, Nvidia's numbers are almost incomprehensibly good. On the other side, the companies spending that money are facing a much harder question. When does it come back? Microsoft, for instance, is targeting roughly $25 billion in AI-related revenue for fiscal 2026. Its capital expenditure over the same period is estimated between $97 billion and $150 billion. That gap between what AI costs and what AI earns is the defining financial tension of this era. At first glance, that sounds like a problem, until you look at what every major technology company has said in response. We're building for the next decade, not the next quarter. That's a reasonable argument. It's also, historically, what companies say right before a bubble. History has seen something like this before. Several times, actually. In 1999, telecommunications companies spent hundreds of billions of dollars laying fiber-optic cable across the United States and under the Atlantic Ocean. The logic was sound. Internet traffic was doubling every few months. You needed the pipes before the demand arrived. Companies like Global Crossing and WorldCom borrowed aggressively, built furiously, and convinced Wall Street they were building the infrastructure of the future. They were right about the technology. They were catastrophically wrong about the timing. The crash that followed wiped out nearly $2 trillion in market value. Bankruptcies cascaded. And then, something strange happened. The fiber sat in the ground, dark and dormant. A decade later, Google bought it for pennies on the dollar and used it to build YouTube, Gmail, and eventually the cloud infrastructure that now powers much of the internet. The lesson wasn't that the investment was wrong. The lesson was that the investors who paid peak prices bore all the downside, while the winners who came later captured all the upside. That pattern is worth sitting with as you watch Microsoft commit $80 billion to data centers in a single year. Now, the counterargument from the bulls is sharp and deserves serious attention. Cloud revenue numbers are moving. Azure's AI-related revenue grew 62% year over year. Google Cloud's AI services grew 48%. Amazon's Bedrock platform processed 3 times as many API calls in the first quarter of 2026 as it did in all of 2025. The demand is real. The question is whether it's real enough. And there are structural reasons to believe this time genuinely is different from prior tech cycles. First, the switching costs are enormous. The moment a major bank, hospital system, or manufacturer builds its internal operations on top of an AI cloud platform, ripping it out becomes as complicated as switching accounting systems. The big cloud providers aren't just selling compute, they're selling dependency. Second, the margin structure of AI services is potentially extraordinary. Once the infrastructure is built and paid for, serving additional AI queries costs almost nothing. The economics look more like software than construction. You spend a lot to build the highway. Then every car that drives on it is pure margin. Third, and perhaps most importantly, the companies doing the spending aren't startups gambling with borrowed money. They're sitting on some of the strongest balance sheets in corporate history. Meta generated $45 billion in free cash flow in a single year. Amazon's AWS is on track to surpass $100 billion in annual revenue. These companies can absorb extraordinary capital expenditure without breaking. So the bear case isn't that they go bankrupt. The bear case is subtler and more insidious. The bear case is that the returns take longer than the market expects. In 2025, Deloitte surveyed nearly 1,900 senior executives about their AI investments. The finding that should make every investor nervous. Most companies expect meaningful ROI on AI projects to take 2 to 4 years. The typical payback period for technology investment is 7 to 12 months. AI is running at 3 to 5 times slower than normal. MIT found that roughly 95% of generative AI pilots produced no measurable profit. IBM put the share of AI initiatives actually hitting expected return on investment at around 25%. S&P Global found that 42% of companies abandoned the majority of their AI projects in 2025. Not because the technology failed, but because the organizational change required to extract value from it was harder than anyone anticipated. The problem isn't the AI. The problem is everything around the AI. Uber gave roughly 5,000 engineers access to an AI coding tool. Adoption crossed 80% within months. By spring 2026, its finance team realized the entire annual AI budget had been spent in 4 months. The COO told analysts the link between AI cost and clear business benefit was not yet visible. even as 70% of the company's committed code was now AI-generated. The company responded by capping per-employee AI spend. One unnamed enterprise, according to Axios, spent $500 million in a single month after failing to put usage limits in place. This is the thing about AI spending that never makes the press release. The bill is due immediately, and the return on that bill may take years. Now, layer in a problem that nobody in the AI industry likes to talk about publicly. Every large language model you interact with, every ChatGPT session, every Google search now powered by AI, every piece of AI-generated code requires electricity. And the infrastructure being built right now requires an almost surreal amount of power to operate. The IEA estimates that data centers already consume about 415 terawatt-hours of electricity globally, roughly 1.5% of all the electricity on Earth. Goldman Sachs projects that number rises 165% by 2030. Deloitte estimates that U.S. AI data center power demand could grow 30-fold to 123 gigawatts by 2035. 1 gigawatt powers roughly 750,000 American homes. The entire partnership between Nvidia and OpenAI alone is built around deploying a minimum of 10 gigawatts of AI compute capacity, equivalent to the power consumption of some small countries. The grid wasn't built for this. The permitting process to build new power lines in America takes years. New nuclear plants take a decade or more. The AI build-out is happening faster than the energy infrastructure can accommodate it. That creates a genuine physical ceiling on how quickly these systems can scale, and a genuine cost problem as demand for power outstrips supply in the regions where data centers are concentrated. There's also the geopolitical dimension, which is where this stops being just a financial story. The semiconductor supply chain, the chain that produces the chips, that train the AI models, that power the products that generate the revenue that justifies the capital expenditure, runs almost entirely through Taiwan. Specifically, through one company, TSMC, Taiwan Semiconductor Manufacturing Company. Nvidia designs its chips, TSMC manufactures them, America buys them, and China wants Taiwan. Nvidia's first quarter 2027 earnings guidance excluded any revenue from China by design export controls introduced by the U.S. government have already cut off the Chinese market for the most advanced AI chips. Beijing, in response, is pouring hundreds of billions into domestic chip production. This isn't a technology story anymore. It's a Cold War, fought in fabrication plants and data centers, with trillion-dollar bets on the table. The CHIPS Act committed $52 billion to bring semiconductor manufacturing back to the United States. TSMC broke ground in Arizona. Intel is rebuilding. Samsung is building. But catching up to Taiwan's decades of specialized manufacturing expertise takes time that markets are not always patient enough to allow. So, step back from the quarterly earnings reports and the analyst upgrades for a moment. Here's what the full picture actually looks like. 4 American companies are spending more money per year on infrastructure than most nations spend on their entire militaries. To build hardware that requires power the grid cannot reliably deliver, using chips manufactured in a country that a nuclear-armed rival considers its own, to serve customers who are still figuring out whether the AI tools they're buying actually improve their bottom line. And the stock prices of those 4 companies and Nvidia reflect a future where all of it works perfectly. That's not a conspiracy. That's just how capital markets work. Investors price in possibilities. When the possibility is large enough, prices can race ahead of reality by years. Amazon's cloud contract backlog recently hit $460 billion, roughly double what it was at the end of 2025. Microsoft's Azure is genuinely growing. The enterprise demand is not imaginary. This is not the metaverse, where Mark Zuckerberg built a virtual world that almost nobody wanted. The demand signals for AI compute are real and accelerating. But demand signals and profitable demand are not the same thing, and history has a long memory for the gap between the two. Here's what none of the CEOs will say on their earnings calls. They're not actually certain this pays off. They're certain that not doing it is the one thing they cannot afford. The logic is a prisoner's dilemma. If Google slows down its data center build-out and AI turns out to be as transformative as promised, Microsoft will own the next decade of enterprise computing. If Amazon pulls back and Google scales up, AWS loses its lead. The only winning move from inside each of these companies is to keep spending regardless of whether the math closes today. So, they spend. And the spending creates demand for chips. And the demand for chips creates Nvidia's extraordinary revenues. And Nvidia's revenues validate the entire thesis. And the thesis drives more spending. The loop is self-reinforcing until it isn't. Gartner has a framework for technology adoption cycles that they call the hype cycle. There's a peak of inflated expectations, followed by a trough of disillusionment, followed by a slow climb up what they call the slope of enlightenment. Generative AI, as of 2026, has been placed squarely in the trough of disillusionment, the phase where the gap between what was promised and what has actually delivered becomes impossible to ignore. That doesn't mean the technology is failing. It means the technology is maturing. Every general-purpose technology in history, electricity, the internet, the smartphone, went through this exact phase. The companies that survived it became the infrastructure of the modern world. The companies that over-leveraged at the peak never recovered. The trillion-dollar question is not whether artificial intelligence will transform the global economy. It will. The evidence for that is already visible in the productivity numbers, the cloud revenue growth, the accelerating adoption curves. The question is whether the investors who paid for the transformation, who funded the data centers, subsidized the chip fabrication, and drove the stock prices to their current heights, will actually capture the returns they expect. In the fiber-optic boom, the technology was real. The timeline was wrong. The investors who bought at the peak waited a decade for the world to catch up with the infrastructure they'd paid for. Some went bankrupt before it happened. Others who bought the rubble became billionaires. The difference between those two outcomes wasn't the technology. It was the price paid to participate. Right now, the market is priced as if AI's full potential has already arrived. The infrastructure is being built as if demand is not just certain, but immediate. The returns are being assumed before most companies have figured out how to measure them. The biggest risk in the AI era may not be that the technology fails. It may be that it succeeds, just not quite on the schedule that $1 trillion of spending has already assumed. Subscribe if you want to understand today's biggest financial stories before everyone else does. Thanks for watching.